To me, fiduciary and fiduciary duty means that our clients' interests always come above and before both our own individual interests and our company's interest.
Excited to have you, Matt. Matt Cole is the CEO of Strive Asset Management and is here all the way from Columbus, Ohio to talk today in our fabulous studio here on University Drive in Nacogdoches. And I'm Jason Barber, and just really excited to have a conversation, mainly just interested in learning more about Strive, the mission, and educating all of our clients that I hope will listen to this and learn more about the goals and your mission and education around the entire concept of ESG and the voting of our shares and the problems that are happening in corporate America and helping people to understand why. I think that is something that for a long time was a question that I wondered is why are some of these companies, not everybody, but why are these companies doing these crazy things? And you start to understand and you start to peel back the onion. And I think that's our goal for today ultimately is to help all of our clients understand why these things are happening and what we can do about it, what actions that we can take, et cetera. So thanks so much for being here. It's really an honor to be able to visit with you, and I'm super excited.
Thanks. It's an honor to be here and check out this beautiful city as well.
Yeah, absolutely. Awesome. Tell me a little bit maybe about, we're going to get to your background and all of that, but I think it really makes the most sense that we just start with, like we talked about, starting with the fundamentals and talking about the idea of what it means to invest in an ETF or what it means to invest in the stock market, just fundamentally, as we like to say, acting like an owner and all of that. Maybe you want to start there?
Yeah. So for all your clients and for you, for myself, it's important for us to think of ourselves as an owner of every large publicly traded company in America, because you most likely are. Because you're putting your clients' money in ETFs, mutual funds, index funds, whatever sort of that vehicle is, or people that have a 401k account, that you end up owning almost every large publicly traded company in America. So when you think about it that way, you say, okay, I actually own Disney. I own Boeing. I own Apple. I own Google. If I'm an owner of these companies, I should be thinking about what would be in the best interest of these companies to make profit, because I'm an owner of these companies. So that is the first core fundamental concept, is if you're invested in an ETF that owns stocks, you are an owner of likely every publicly traded company in America. But you're not actually voting the shares. You're not engaging with the companies. When you own an ETF, you are entrusting an asset manager as a fiduciary to you to implement and push great actions from these companies to be the best versions of themselves, to provide excellent products, to provide excellent services, to hire the best person for whatever job that they might have available that they're trying to hire for. Doing simple, basic things to make money for you. And that is where we've gone off the rails in the asset management industry. It's why Strive exists, and we'll get deeper into that. But it's that fundamental problem. Pretty simple.
Yeah. Just for those that maybe, the word fiduciary is a hot button word. We use it a lot, and it's becoming more commonly known. But do you mind maybe just explaining if you were to give it a definition, what you think that word means?
Yes. To me, fiduciary and fiduciary duty means that our clients' interests always come above and before both our own individual interests and our company's interest. And if you can't say that and you're not doing that, you are failing to act as a fiduciary. That is something that every single person here listening to this podcast should demand of you as an advisor. Whoever you are choosing as an asset manager within your portfolio should be demanded of those asset managers. And if there's a question or if they're not meeting it, that's a major problem.
Yeah, exactly. I like to think of it as it would be no different than if I was to say, hey, I am I and Steve and Taylor own Holistic Planning LLC. We own this business. This business generates revenue and hopefully generates a profit. If we were to if you were to invest money in our business and you said, hey, Matt's going to be a 10% owner of Holistic Planning, we would have an obligation as managers of this company to put your interest above the interest of Holistic Planning's interest, right? It would be, you're an investor in this, you own this business, we have an obligation to you to look out for you and to do what we believe is in your best interest. Is that it, basically?
And it's simple. And I actually think that, generally speaking, fiduciary interests also tend to maximize value for a firm.
Yeah.
If you go to your clients, and I know you all do, and say, we will put your interest first, that generates trust.
Mm-hmm.
Trust generates longer-term relationships. Longer-term relationships makes a better business.
Yeah.
Right? These things should not be misaligned, but they
Mm-hmm.
oftentimes get misaligned.
Mm-hmm. Yeah. So I guess then the question is that it's what is in, using that analogy, right? What is in your best interest, right? Your best interest, I would think, as an owner would be to make money, right? Is that kind of, should we simplify it that much? Or is there more to it than that, you think?
It should be that simple unless an explicit mandate was given to you or to me to do something otherwise than that.
Mm-hmm.
That is the core fundamental principle. If someone gives you money, someone gives us money to manage, I am going to maximize return within whatever risk limits there might be or whatever for the client, unless the client says, I don't care about maximizing value. I want to have some sort of values implemented in my portfolio or some sort of charity dynamic that they're aware of, they sign off on. Then you can still meet a fiduciary obligation without maximizing value, but it needs to be consented and explicit.
Mm-hmm. Changing gears just a little bit. So on the whole voting aspect, and I actually genuinely don't know the answer to this. So if I'm in an ETF or a mutual fund, I'm asking the ETF manager or the investment manager to vote my shares for me. I'm assuming that I don't even have a choice, right? Is that fair to say? If I'm in an ETF, do I even have a choice to vote my own shares? Or is
Typically, no.
Yeah.
They're starting to implement some version of choice into the vote, but the choice is still an incomplete solution. So,
and how could you possibly do that if there's 500 companies? If I'm buying an S&P 500, there's no way I could vote on 500 things.
No, there exists some technology now to, if you have your money with an asset manager, they might say, hey, do you want to vote your shares this way or that way? But what's important, though, is that as an owner of the company, it's not just voting. We talked prior to the podcast a little bit about private markets and talking to boards, and it's also about your relationship with these companies, engaging with these companies. And as an asset manager, I can only engage in one manner. I can't say, Jason wants me to engage this way, Mary wants me to engage this way. And you basically say, hey, this is our view, because you have an hour meeting with the C-suite of whatever large company to talk about your view. You can't talk about 5 different views. You can vote shares potentially in 5 different ways. We take a different approach, that we fundamentally believe that there is one way to maximize value, to implement excellence, and that's what we do. And so for someone that doesn't want value maximization, then we would not be a good asset manager for them. But I think these votes tend to be pretty black and white on pro-capitalism, pro-meritocracy, or not. And so we think that for most people, the answer is pretty clear.
Meritocracy is a big word that I think, speaking for myself and for our business, that's just the way that I have always believed the world should be, is that we should not look at people by their gender, their sex, their sexual orientation, their race, their anything, and we should just focus on who's the best for the job. And I think that's a lot of what there's this conflict in America right now between that idea versus, I guess, what they call stakeholder capitalism and all these different things of what matters more. Are we making a difference in the world, or how are we actually going about affecting these differences? And I think that's where a lot of the conflict maybe comes from. So I know we're getting in the weeds a little bit, and I wanted to steer or redirect to maybe what's going on with Boeing right now, what's going on with Disney, with Anheuser-Busch, et cetera, and why are they doing these crazy things, and where's the actual root of the problem, and how is Strive fixing this? What's the vision there?
Let's start with an example and then zoom out a little bit and look at what the entirety of these publicly traded companies look like and how most of their incentives compensation schemes have moved away from merit as a core principle. But let's start with Boeing because it's been in the news pretty frequently. Boeing actually from the year 2000 through 2019, 19-year period, was one of the top performing stocks in the entirety of the S&P 500. It had outperformed the S&P 500 by a whole. And this is in a period of both the dot-com bubble crash and then after 08, 09, a period where tech stocks actually did really well, right? Tech stocks were outperforming, yet during this 19-year period, Boeing outperformed the entirety of the S&P 500, including tech, right, by a massive margin. Then in 2019, Boeing started to lose its way. And so what happened in 2019? There was an initiative by the Business Roundtable, which is a group of some of the largest CEOs in corporate America. And 181 CEOs, including the CEO of Boeing, also the CEOs of BlackRock, name your large asset manager, signed a statement that said, we are changing the purpose of a corporation. Shareholder primacy is outdated. So for people that don't know, shareholder primacy is the concept. It's basically fiduciary duty, that the shareholder, you as an ETF owner, are the most important stakeholder in an organization. They said this concept is outdated. And today, corporations need to earn their social license to operate. So really enter the ESG and DEI movement on overdrive. It had existed prior, but this is when it really started to pick up steam, 2019. So Boeing signs this statement, 181 other CEOs sign the statement. And then a couple of years later, Boeing implements a change to how they actually incentivize through compensation their CEO and their C-suite. They implement compensation based on ESG and DEI measures. So you must hire a certain amount of people of a certain race or a certain gender for all these different jobs at Boeing. But not only that, also all the suppliers that provided parts to Boeing also must meet these DEI requirements. And so that was literally 2022. And then in 2023 and 2024, you start having literally doors flying off the planes of Boeing, and it literally is every single week there's another malfunction of a Boeing plane, the CEO's stepping down. And what was the impact on performance? Sign that document 2019 through now, over 100% underperformance versus the S&P 500 in a period of about 5 years.
Wow.
And so it's important to realize that obviously these go away from, I would say, pretty simple concepts: hire the best person for a job, period, merit. But the financial performance difference can be massive, and it can be very quick when you start providing an inferior product. And with Boeing, it's extremely important, right? Because an inferior product means people start questioning the safety of a product. So it has implications for Boeing even to a greater degree than it might degrade some a soda manufacturer or someone like that, right? Because people's lives are at stake.
Literally, yeah.
Yeah, so that's the example of Boeing.
So why would Boeing do such a thing? Like, why would they sign this letter? Why would they change their executive compensation? What's in it for them to do that?
So who does Boeing answer to? That's actually the answer to the question. They answer to the owners of Boeing. So yes, the owners of Boeing are your clients, but when the clients of every financial advisor around the country have entrusted a couple of asset managers to vote and engage with these corporations on their behalf, then the question becomes, how have these handful of asset managers been engaging with these corporations? So now we're talking about BlackRock, State Street, Vanguard, Invesco, Fidelity, you name it. And they all also signed all these statements, made these pledges that they were calling American capitalism outdated. They were claiming that they were going to, quote unquote, this is their words, not mine, force behaviors into corporations. And when they say force behaviors, they were going to force DEI into corporate America. And then the next question is, how much of Boeing does these large asset managers control? And the answer is over 0.25%, over 25% is just with these large asset managers. But how do you get to 50? Here's how you get to 50. You have these large asset managers, then you also have proxy advisors. And these proxy advisors, they also vote on behalf of clients. And there's two main proxy advisors, ISS and Glass Lewis. Neither of them are American corporations. And why that's important is because they come from Europe and from Canada, places that American capitalism isn't an ideal. So they don't actually have that fundamental belief of American capitalism. So they also implement a non-American capitalism version into American corporations. You have over 50% of the vote, and you can quickly implement things that aren't in the best interest of the shareholder.
Yeah, so when you talk about the proxy, the ISS, for example, that's for folks that don't own an ETF or a mutual fund, but they actually own the individual shares of Boeing, for example. But maybe they decide that they don't want to actually vote themselves, so they say, hey, I'm going to hire this. And it's not like there's a ton of options, it sounds like, right? We've just got basically these two international companies that have cornered the market there.
Yes, and the reason why is there's two reasons. One, it's a lot of work for an advisor or any individual institution to vote your own shares. Like Strive has a team of over 10 people, full-time people, doing research in all these companies, doing research on every board member. Yeah. It's a very expensive endeavor to do for a local mom and pop financial advisor. You would have to charge so much fees that it just doesn't make sense. So you say, okay, I want to do my fiduciary duty. I don't have the resources to do it well internally. I'm going to outsource it. Do I hire ISS or Glass Lewis? And then they also are trying to provide a cheap service, right? Because you don't want to pay a lot of money. So people don't want to pay a lot of money. And that business also got corrupted because ISS and Glass Lewis, they actually don't make most of their money through their voting side. They actually make it through their consulting side. And so this is actually very similar to in the Great Financial Crisis, you had the rating agencies, S&P, Moody's, Fitch. They actually would give, so I came from institutional background, I was at CalPERS. They would give their ratings to places like CalPERS, name your institution for free. You say, how are you providing it for free? You're providing it for free because you're actually charging the company to rate their debt. And so you consult with them, and if they pay enough, they'll help you get your rating up to the right level, right? Which then implements a breach of fiduciary duty, right? Because you're getting paid by the person you're rating, right? And so ISS and Glass Lewis are getting paid by the corporation that they're recommending votes on. And so it's how you get these incentive misalignments in the financial system that have pretty dire consequences.
Yeah, exactly. That is, I was just thinking about that movie. I'm trying to remember the name of it right now.
Big Short?
The Big Short.
Yeah.
Yep. And they went there and they're talking about those ratings for these bonds. It's completely, I don't know of any other word to use other than to say it's corrupt, but it's a wild world that we live in. So that we've got the big asset managers and these proxy folks are controlling, let's say, half of the vote, or at least enough to seriously sway things. They basically control the world, for lack of a better term, to a large degree. And so unknowingly, folks like you, and not you now, but maybe in the past, or me, up until recently, a lot of our clients are unknowingly voting a lot of, unfortunately, whether we want to admit it or not, a lot of these crazy initiatives, our own dollars supported that in a sense, right? Is that fair to say?
It is. And the beginnings of that was a movement. So initially, there was a move in left-leaning values states that wanted to implement an agenda to corporate America to divest from corporations. And what they quickly learned is when you divest, you lower your returns, you lower your ability to maximize return per unit of risk. So I said, all right, let's not actually divest this clearly cost. Let's stay invested, and then let's use our shares to change corporate America. And so that's how it started. And I think a lot of the large asset managers initially signed on to this, looking at it more as a marketing opportunity of, hey, there's this small group of people that care about all these different name your, political issue of the day. We're gonna vote our shares in this way. We'll win more business. And then they started changing corporate America, and then there was a backlash that you're breaching your fiduciary duty. Look at what happened to Boeing. Look what happened to Disney. Look what happened to Anheuser-Busch. Name your corporation. Look what happened to Google recently with their AI machine that they had to shut down. I actually think that's one of the most underappreciated risks, because right now Google's majority of its revenue comes from search. The future's AI, and you've just damaged trust in your future revenue stream. That is a massive risk for that corporation.
I could not agree more. I could not agree more with that.
Yeah.
So the ultimately, not to add another wrinkle to this, but really the boards are the people that are actually implementing all of these crazy, hey, we want to change executive compensation. BlackRock isn't actually forcing Boeing to do that, right? It's just BlackRock is voting in people to the boards of these companies that are in charge of these companies that set the rules, and they're putting people on there that they think will do what they want them to do. Is that maybe the better way to put it?
Yes. And if current board members won't do it, they are on the record to say we will vote them out.
Exactly.
And so do this or we'll vote you out. When you vote new people in, we're going to vote new people in that are aligned with implementing this agenda. And then now you get to this point where literally 2010, there was not a company in the S&P 500 that tied executive comp to ESG or DEI. Zero. Today, it's over 75%. So 14 years, 0 to 75. And then once it's at the board level, the CEO implements this further down the chain, or they don't get paid. So then you get the rise of the DEI offices and all these corporations in America. And so now you have this inefficient, I'll call it rot in corporate America that has to be removed in a painful manner. Either reassigning people or removing people from certain jobs in corporations, changing the board to have a board that's more aligned with implementing value maximization as a core principle. There is a lot of work that needs to be done in corporate America to actually unwind this. And so it's been great that I think now it's pretty popular to call out all the different things that you're seeing in corporations that are falling. You see it all the time on Twitter, and people feel comfortable calling out these inefficiencies, which I don't think they would have felt comfortable even talking about this, most people a couple of years ago. I think it's great that they feel comfortable, but there's a lot of work to actually fix this. And who is fixing this? The large asset managers are failing to help. And I think that they are concerned that if they actually were to help, they admit that they breached their fiduciary duty in an explicit manner.
Yeah. How could you possibly? It's like, how do you undo such a thing? It's crazy. The only way is lawsuits. People force you to undo it by lawsuits. So it's almost like they're in this position of, I either admit that I did something wrong and I get sued, or I don't admit that I did something wrong and then people sue me, and then I just say, okay, like, we'll change it now because we got sued. And I'm still not admitting that I did something wrong, but we're going to slowly, quietly change things. Maybe that's how this thing eventually ends up self-correcting, I hope. I don't know, but
I think it's lawsuits. It's also companies like ours, Strive, that as a long-term holder, even though we're the fastest growing ETF issuer in 20 years, but we're small, right, on the grand scale of things. But just having someone standing up as an owner on behalf of clients, saying this makes sense. Now there's one person at least on your cap table that's standing up versus zero. That makes a big difference. 0 to 1 is much more impactful than from 1 to 2. And I think we will get 1 to 2 and then 1 to 3, right? But just having someone that already starts to put pressure as at least one owner.
Exactly.
And then lawsuits come up. And I think this stuff does get unwound. But an important question is, it gets unwound. What do you want in an asset manager? Do you want someone that's swaying with the wind, that whatever pressure gets
popular?
Or do you want someone that has firm principles?
100%. Yeah, no, there's no doubt about it. You want firm principles. So talk to us about, I think the idea of value versus values investing makes a lot of sense when you think about it. I want to tell a story real quick. So when we first broke away from Edward Jones, and we knew that we needed, it's so funny, we knew we needed something like Strive, but we didn't even know Strive existed at the time. March of 2023, didn't even know about it, unfortunately, or I didn't anyways. And so we were looking around at all these different values, which you'll explain here in a second, funds, and considering these different offerings that exist out there. And they're basically, just in looking at it, the opposite of an ESG fund in a not good way, right? They're excluding, like how ESG funds used to exclude tobacco companies and used to exclude oil and gas companies, et cetera. And then they realized that they're not actually affecting any kind of real change by excluding these companies. And on top of that, they're probably underperforming and whatever else. And so then on the flip side, you've got these, whether you want to call it conservative or Christian or whatever the term is, where you say, hey, these are Christian values funds. But then the problem, of course, is that I'd love to hear you talk about the example of Nike and things like that. But who's the person that decides this company is more Christian than this company? And then you end up with this, you're going to dramatically underperform the index because you excluded Apple from the company. And on top of that, if Apple's actually, are you actually affecting change? Are you affecting change by divesting, right, from these companies? And the answer is you're really not. Things are not going to get better just because you said, hey, I'm protesting and I'm just not going to own this stock. Nothing changes. You've got to have somebody that's standing up for value instead of values. And so I think maybe that might be a good thing to talk about.
Yeah, and this is one of the most important things to talk about as a fiduciary. It's not to really take a position of degrading certain values.
Mm-hmm.
We all have different values, and I'm a strong Christian. I have those values as a person.
Mm-hmm.
I don't want those values in my portfolio. I want my portfolio focused on maximizing value, because no matter what your values are, whether your values are really focused on the climate agenda, focused on DEI and race issues and moving away from merit into corporations, or pushing Christian values or conservative values, it's important to remember that anytime you're thinking about values in a corporation, you're implementing a constraint.
Mm-hmm.
A constraint to say, don't do X, whatever X is, because X is contrary to my values.
My personal values.
My personal values,
Yeah.
right? And everyone has values,
Mm-hmm.
right? But if you think about them as a constraint on a corporation, then you say, if I put a constraint on a corporation, there's a cost to putting a constraint on a corporation. And am I willing to pay that cost? Question one. Question two is, do I think that me trying to implement those values on corporations is even going to be successful? Question two. Or is it just going to cost money and then have it unwind, and I footed the bill of a massive failed initiative to implement values into corporations, which I think is ultimately, in a few years from now, where we see the ESG and DEI movement failing, it'll fail, and it'll fail at a cost of billions, probably trillions of dollars to investors, that this was tried to be pushed into corporate America and then unwound at a massive cost that unfortunately all of us are holding the bag for. And so you see corporate America moving to the left, and I think it has moved very strongly to the left with values. The question goes, do I want to move it to the right with values, or do I want to move it forward focused on value, American capitalism principles? And I believe that's the right answer. And I think it solves so many problems that we have. And one of them is, if you just think about humans flourishing, well, what happens when you actually focus on maximizing value? You're incentivized to innovate. Technological innovation happens. If technological innovation happens, we're all much better off as a society. If we have better returns, we have more likely chances of having a great retirement. I think it's pretty clear we have a retirement crisis in this country.
Mm-hmm.
You constrain returns. There's really two different visions of how you fix this retirement crisis. There's the World Economic Forum stakeholder capitalism vision. That vision is you'll work way longer in life. You won't own anything, but you'll be happy. You'll accept lower returns. Or there's another version, obviously be financially responsible, save money, but accept the higher returns that capitalism provides, that meritocracy will provide. Accept more technological innovation in the world, which will help human flourishing, and be much more likely to just have a great retirement at a normal age.
Yeah, when you talk about flourishing, I was thinking, I have two things that came to my mind with what you just said. One was this, is it called the CHIPS Act? Is that what it's called? And I'm sure
CHIPS
you're familiar with this thing that I'm not intimately familiar, but I was reading kind of the high level details about how we've got this billions of dollars set aside to reduce our dependency on, is it Taiwan maybe? And we're gonna have, hey, let's get Samsung and all these people to say, hey, we need to start making these semiconductors here so that our Ford pickup trucks can actually we don't have this chip shortage with all these problems, or if we got problems with China in the future, et cetera. We need to reduce our dependency. And then we implement these insane DEI policies or whatever they are that are just simply don't make sense. And then what happens? Nothing happens, right? Is that fair to say, right? Nothing has actually happened, even though we had these great plans.
Yeah. So there was this large pot of money that was put away by the federal government to be doled out to all these chip manufacturers to onshore chip manufacturing into the United States. And exactly your point, there's a major risk because chips are really the new oil right now, that pretty much everything you use, obviously your phone, but even things like your washing machine or your refrigerator, they have chips in them. And we're completely dependent on Taiwan. They produce over 90% of the most advanced chips in the United States. So, and there's this risk that China will annex Taiwan possibly as soon as 2027. And if that were to happen, our ability to get the most advanced chips almost goes down to zero. So huge risk. So we want to onshore, as an issue of national security and flourishing, chip manufacturers back to the United States. And it probably needs to happen in the next couple of years because of this risk, right? And so this large pot of money, and then what happens is that the White House can't give out this money. And you say, why is it happening? And then you start seeing delays, that Intel's delaying their chip in the United States and Columbus, and then TSMC is delaying theirs. You say, why is it delayed? You read the bill, and there was all sorts of DEI pork that you must hire a certain percentage of women, minorities for all these different positions. The most obvious one in there was construction workers. A large percentage had to be women, which there just really doesn't exist very many women construction workers. So they couldn't find the people to do the job. So then they delay it, and they're delaying it past this 2027 initial deadline. So now you literally already have, even if they were to give the money now, which hopefully they do, hopefully they work through some of this DEI pork. I think there's actually now, we wrote an op-ed on this, and now it might actually change some of the legislation in a positive way, which is great. But they're already being delayed, and we have a massive security risk because we put all this pork in there versus just, hey, let's hire the best people, get this done.
Let's come together for America and do what needs to be done and get it done, in a capitalistic way. The other thought that I had when we were talking about, I think, the value and values, is the analogy or the story that comes to my mind that I always think about is the great story of Michael Jordan and the shoes. And I'm sure you've heard this story, but for those that are listening that maybe haven't, and I'm probably going to butcher it, but I think the story goes that when Michael Jordan was at his height of popularity, or maybe, I don't know what part of his career, but he was certainly very popular. And I think there was a politician in North Carolina, maybe a Democratic politician, that asked for his endorsement. And I think that he declined to endorse him. And so, of course, a lot of people got upset about that, to which I think he famously said that Republicans buy sneakers too. Okay. And then now you look at this guy and you think I'm pretty sure he's a billionaire or close to it. Okay. And you think, man, he was so smart and savvy to basically say that we should not eliminate half of the people that would want to buy my sneakers by me making some type of a political move here. And so that's what's so important, I think, in this whole thing, is folks understanding that this isn't a Republican, Democrat, a Christian, atheist issue. Okay, this is we would feel, I think you would agree that you would feel the exact same way about this issue if Anheuser-Busch had donated $100 million to build the wall. Okay, you would say, wait a second, Democrats drink beer too. Right? Right? Like, why are you guys doing that? Number one, how is this good for the shareholder? But number two, like, why would you do something to cause this political strife and create a boycott against your product? It makes no sense. Yeah. So
exactly. And the core principle that large corporations, CEOs should follow around this is be a mission-focused company. So whatever your mission is, focus exclusively on that. Bring your employees, bring your customers together around that mission, that people that like your company will be brought together. If you go to see a basketball game or a football game, it shouldn't be a Democrat thing or a Republican thing. It should be a thing that Americans come together, put aside their differences. It actually is one of the things that makes our country great when we have these places. And I firmly believe that your place of employment, especially if it's a large corporation, I think there's room for smaller corporations that are Christian, left-leaning, whatever, that have more of a values tilt to them, but they're likely smaller corporations. Our largest companies in this country should provide products, provide employment to everyone.
Yeah, absolutely. Oh, you know what? Let's talk about these studies that are coming out that talk about how diversity leads to corporate outperformance. I think that's a really interesting thing. And then also after that, let's make sure we talk about where this whole thing started, like why BlackRock, why do they take these positions that they take, et cetera. I don't know if we really made that clear as far as going back to the '08 financial crisis and all of that. I think the picture starts there. So maybe actually let's start there and then we'll talk about these studies.
Yeah. So in 2008, the start of the great financial crisis, you saw obviously the stock market correct in a major manner, but you also saw this fiduciary breach in a major way of the largest financial institutions in this country. We talked a little bit about earlier about S&P, Moody's, Fitch, how they had been rating this debt in a way that did not correspond to the actual riskiness of this debt, right? That then you had all these institutions and advisors that bought this debt thinking it was safer than it actually was because there was this conflict of interest. So a massive decrease in trust in Wall Street happened. And so Wall Street was faced with a significant dilemma at the time. And the way that they tried to get out of it was to try to paint themselves as the good guy. And the good guy was, I'm going to be the good guy because we are going to start standing for a climate agenda. We're going to start implementing that. We're going to start implementing diversity, higher diversity across corporate America. And we're going to provide a good, quote unquote good, which depending on your values, you could call it good or you could call it bad, but for at least a small segment of America, younger people that were very left-leaning, but some whatever, to agree or disagree with that, a small segment of America will be the good guy. And that was to try to quiet this opposition to Wall Street. There was protests in New York.
Because they're the loudest, right?
Yeah, and so I'm going to silence these protesters that are outside of our door calling us evil by bending the knee to them. And that is where you started to see this movement to change the largest corporations. And that was 2008, but it picked up steam over the years, right? So it wasn't by chance that 2019, 2020, that you started to see all these corporations make public declarations of support for Black Lives Matter, or Delta Airlines that literally came out in opposition of a voting rights issue in Georgia that said, why, I don't even care what the issue is. Why is Delta Airlines talking about voting on a political election, right? And it was really just this movement away to try to be the good guy. And at the front of the line trying to do this was BlackRock.
Yeah, interesting. And then I think that you maybe have talked a little bit about before how they're also influenced by these huge pension funds, for example, right? And things of that sort, CalPERS, where you used to work, or others, right? Have some influence in that.
And the reason is that these large pension funds, CalPERS is an example, $500 billion. And so you have this large pot of money, and that large pot of money becomes the biggest customers for these asset managers like a BlackRock or like a State Street, both with the assets that they manage, but also they have technology and risk platforms that they use that multi-million-dollar contracts every single year to leverage the BlackRock system or the State Street Charles River system. And so you have your largest client, and your largest client says, I want you to implement this ESG or DEI values agenda. And you might say, why does CalPERS care so much about it? It's obviously, it's California, left-leaning state, but this gets into some of the corruption that exists in the large pension funds in America. And this is actually true for most states, whether it's a left-leaning state or a blue state or red state, is that these boards of these pension funds are mostly appointed by the governor of the state. And so in California, you have a 15-person board. 8 of them are directly appointed by the governor. And they appoint people that don't have investment experience, that have a pretty explicit political agenda, right? These governors were elected on a platform, whatever their platform is, like it or don't like it, right? And so then they start pushing that platform down into the pension funds to use the money of the pension funds to implement a political agenda.
It's just so unbelievable how deep it goes. It's just crazy. I know we probably take for granted that people understand exactly what Strive does, but I think it might be a good moment to say, okay, that's BlackRock, that's Vanguard, that's State Street, that's American Funds, that's Capital Group, that's all these other people are influenced by this. And Strive is taking the opposite approach of that, which I think I'll say one thing too, is that I feel as the person who is acting in a fiduciary capacity for our clients, that one thing that makes us special and holistic planning was our name is that we don't stop just at let's just pick a fund and then let's not worry about what's actually happening after that, right? One of the things that we like about Strive is this idea of, hey, we are going all the way down to the very nth degree of, are we fulfilling our fiduciary obligation? Are the people that we entrust our clients' money to, are they holding our clients' money in a fiduciary capacity and looking out for our clients and doing the very best that we possibly can? And I just think that's what's so neat. And I was talking a little bit earlier about how we were looking at these different things. And I very vividly remember Taylor showing me Strive. And it was like the first time we saw the video, it was like light bulb went off. This is exactly our values, our fiduciary obligations line up so much with what you guys do and what you guys believe. And that's why we're so excited to be partnering with you guys to put our clients' interests first. So all that being said, so we know what BlackRock does and what we don't like about that, and Vanguard and all of the others. And you guys, it's fair to say that, hey, we're just trying to get exposure to the market. So our performance, if I'm investing in a BlackRock S&P 500 fund and I'm investing in a Strive S&P 500 fund, for example, my performance should be essentially identical. Is that fair to say? I'm not trying to outperform with Strive necessarily, right? We're just trying to get beta performance.
Yeah. So there's 4 factors that typically you're looking at when you choose an ETF or a mutual fund for an index fund, right? Which passively managed stock market exposure. They are risk, return, fee, and then the 4th one is how are they voting and engaging these shares, right? And so the whole idea with Strive was most people, at least on the equity side, are investing in passively managed funds because almost all actively managed portfolio managers underperform over a period of 10 plus years. So that's how you've gotten this rise of the index fund, right? And you had most financial advisors just saying, all I'm looking at is risk, return, and fee. And you look across all the large asset managers, and what you find is basically identical risk, return, and fee. Strive is no different. Very similar risk, return, fee profile. But the approach for voting and engagement is very different. And for most asset managers besides Strive, it would be very similar risk, return, fee, and approach to voting and engagement where they are implementing this ESG and DEI agenda. Where Strive takes a massive differentiator on that last thing, where we're only voting, we're only engaging with corporations to maximize value for their shareholders by focusing on providing excellent products, excellent services, hire the best person for any job, period. Really nothing that's actually that complicated, but it's become the contrarian position in the asset management industry. And we talked about some of the reasons why it got implemented from the great financial crisis, how it's picked up steam now. And now you have all these large asset managers that have gone on the record, public statements. We are pledging to implement whatever DEI agenda, certain quotas, certain restrictions on emissions beyond the law in the United States. So not even just follow the law, but actually, reduce it even more and put climate activists on the board of oil and gas companies, all these different things. And they can't undo it without explicitly breaching their fiduciary duty, as we've talked about. So whether they want to or whether they don't, we don't know because they're not going to say, but they can't either way. And so Strive stands alone in our approach to governance as a way of just maximize value, period.
So I know you talked a little bit about how, hey, 0 to 1 is a big deal. And where do you see, obviously, I see Strive continuing to grow. You talked about you guys are the fastest growing ETF, or is it ETF or just fund company
ETF
in, you say 20 years?
20 years, yeah.
Right? What does that look like? Can you share with us if things were to go, other than, because I'm a big believer in just like I think maybe the way you said it was, even if all of this DEI craziness and all of these things stop entirely, I still want Strive standing up for what's right, period. And knowing that's the fundamentals or the core values of the organization, to me, make me like it no matter what. But I'm curious, is there a certain size or a certain game plan where it's, hey, I think if we reach X scale or this, that we can really move the needle more? Or is it just one of those things where it's really just more of, hey, we are moving the needle today because we are, at least we're one voice in the room, period. Okay. Mm-hmm. Which I buy that at the end of the day, the reality is that there's so much money. These large asset managers have so much that it's impossible to imagine, maybe not impossible, but it's difficult to imagine a day where Strive is the number one shareholder instead of BlackRock, for example. But is there a point you think where it's, hey, if we get to 10x where we are today, that our voice is loud enough or more loud even than it is today that we can have an even bigger impact? Am I asking the question the right way? I'm not sure.
Yeah, I understand.
Yeah.
It's probably going to matter less the explicit percentage,
mm-hmm.
but what matters more, in my opinion, are a few different things. One is that if you're growing very quickly, there's clearly demand for what you're talking about. $1 billion or $10 billion, if it's followed because it's been growing quickly, that punches a bigger impact than $1 billion that's had no growth for 5 years, right?
Mm-hmm.
That's like a stale corporation.
Exactly.
And so I think as long as we're growing, we'll be able to punch well above our weight. That I think it's impossible to quantify how much above our weight, but just as an example, we're expecting somewhere in the neighborhood of 5 to 10 companies in the S&P 500 to roll back part or all of their DEI or ESG incentive compensation this year, based on us being the only person in the room calling out this risk in these meetings to these people.
Yeah.
That's very large impact for a company that's our size.
Yeah.
Right. I think we'll be able to continue to punch above our weight. Another thing that's going to be in our favor is that we only launched about 18 months ago.
Wow.
And so we are a new company on the cap table of these corporations. So sometimes these calls are kickoff calls, right? Who are you? This is interesting. Just like you heard it. This is interesting. Let's have another meeting. But these relationships take time to build. So take time to build. Large growth. We'll be able to continue to grow our voice. But with regards to people investing with us, it's similar to what you talk about, where we're just going to do the right thing.
Exactly.
Every single year. And we want, as we build that trust year after year that we're doing the best thing, I hope that it's all unwound next year. And if it is, we'll be the only company that was, as an asset manager, that was pushing to unwind this.
Yeah.
I think that's going to generate a massive interest. So I want to win this as quickly as possible. I think it's going to be a long battle, but I think every year it's going to be chipped away at.
If you had to guess, I know you don't know, but when you talk about a long battle, 10 years, 5 years, what is long in your mind?
This movement really picked up steam over 14 years. We talked about 2010, zero companies doing ESG or DEI, now 75. I think we're basically at the peak right now.
Yeah.
And so if I just think of a bell curve, maybe it's 14 years to unwind it, 15 years, something along those lines, but not 15 years, nothing happens. Year 15, it's all gone.
Exactly.
Examples every single year of success.
Exactly. Maybe in the next 5 years, we've made a lot of progress, but there's still those outliers but it becomes more of 5 years from now, 7 years from now, these things are still existing and you're like, you guys haven't got the memo that like, we don't really, that's so 2020.
Yeah,
right.
Exactly.
That's so 2020. We don't really do that. We don't really do things that way anymore. There's a lot of folks around here that are big into oil and gas and the oil and gas industries, and we're obviously close to Houston. We talked a lot about some examples. Everybody's familiar with what's going on with Boeing and Anheuser-Busch and all of that. But I'd like for you to maybe share the story of the activists in Chevron and Exxon and what's going on with that a little bit, if you would, just because I think a lot of people around here might be interested in that.
Yeah. So let's start with Chevron. So in 2021, there was one of these ballot initiatives that happened for every company in America. And this ballot initiative for Chevron said Chevron would be required to reduce their Scope 3 emissions beyond the law. So Scope 3 emissions, maybe some of your audience knows what those are, but what those are is they're the emissions from both the suppliers that supply whatever it might be into Chevron, and then also the customers of Chevron. So up and down your entire chain of your company, looking at the emissions. And so most companies have no idea what their customers are emitting or their suppliers are emitting. They might know what they are themselves emitting if they're trying to track it, not naturally, but you have no idea. So they got this ballot initiative. Chevron said it makes no sense for us to not only try to track what our customers and suppliers are emitting, but also trying to reduce them. That doesn't make sense for us as trying to make money. This initiative should be voted against. But most of the large asset managers, the BlackRocks, the State Streets, the Vanguards of the world, voted for it, implemented it, forced it on to Chevron. And this is clearly a constraint. Not only is it a constraint that they have to reduce their Scope 3 emissions, but they also had to implement a very costly model to even try to estimate what these emissions were. It made no sense. It wasn't the law. And when you look at why these large asset managers voted in, their statements were very vague. It was things like, these are things we expect of our portfolio companies. Expect. Okay. But why is this making you money? I don't understand, right? Because it doesn't.
Yeah.
And so that was Chevron.
So these are not ESG funds, though, right? It's not, oh man, like the people that want their money in ESG funds, they want you to vote that way, right? Like this is like my money, and any of our customers that have money in the Vanguard or BlackRock index fund that owns Chevron, that might work for Chevron or might literally be like this is actually going against, this is hurting them financially, and they didn't have any desire to vote in a values fashion, right? They didn't sign up to vote in a values fashion, and yet BlackRock is doing this
with all their shares.
With all their shares. And so that's the crazy thing, is that you think, how in the world can they do that and not be in breach of their fiduciary obligation to the people who they're supposed to be putting their interests first? It just is remarkable how that can happen. So
it is. And in my view, it's a clear fiduciary breach. And I think that as some lawsuits, if lawsuits come, will probably show, because when you start looking at these things and questioning them and saying, hey, how does this make sense? You really have to go through some kabuki theater to even try to justify it. And so we talked about Chevron, Exxon. This one, in my opinion, is even wilder. And so in Exxon, also 2021, a slate of 5 climate activists got put up to be nominated to the board of Exxon. Had no oil and gas experience. And you might say, why would a climate activist add value to the board of the largest publicly traded oil company in America? I can't think of a reason. But
sounds like Hunter Biden.
Yeah, exactly. So. But 3 of them actually got elected. 3 of the 5. 3 of the 5 were approved and voted on again by these large asset managers. And not surprisingly, Exxon fought it tooth and nail. They said, this makes absolutely 0 sense whatsoever. And Exxon's, so you get these 3 climate activists that get put on 2021. And this is one of our bigger wins as a company, actually. So 2022, we launched, our first fund was an oil and gas fund. Now we have, 500 fund, value fund, growth fund. Name your fund, we probably have one. And the reason was pretty simple. It was like, okay, our plan is to launch, name your fund, we're going to have one. But the oil and gas sector had been so negatively impacted by the ESG movement, because this is right after, 1 year after this Chevron issue happened on Scope 3 emissions. Climate activists got put on the board of Exxon. And you're just like, okay, there's a huge issue here. Not only is there a huge issue, there's clear alignment from most employees at oil and gas companies that they see themselves as providing a fundamental good for human flourishing, and their companies are being villainized, that they're ruining the world. And so the employees didn't like it. The companies didn't like it. We saw it as really impacting share performance. We said, we're going to start here because we think we can have a big impact in this sector very quickly. And so our second engagement, our first one was with Chevron about the Scope 3 emissions. Our second one was with Exxon about these climate activists on the board. And we said, Exxon, you had 3 climate activists put on the board. We understand you didn't want it. We're going to put up some qualified candidates to get put on the board because maybe we can't get those people removed at least before their terms are up. But hey, if this is a democracy on the board, put up some more people on the board, just grow the board, and you'll wash out those voices that are trying to shut down your company. So we said we were going to run a contest. We were planning on running a contest. And then less than 2 months after we sent that letter, which is a public letter, you can see it on our website to Exxon. You can see this whole timeline publicly. We sent this letter less than 2 months later. Exxon just took the proactive step and they put 2 qualified people on their board that had direct oil and gas experience to offset the voices of those climate activists. And I thought that was a very bold move of Exxon to say, maybe, I don't know why. We don't know why they did it without a vote, but hey, I thought that was even a more bold movement, right? To say, hey, like, the response to this letter, yes, we agree. And now there was another proposal at Exxon this year, some crazy climate activist trying to do something. Exxon sues them. They actually removed their proposal, and the SEC made it much easier to put up crazy climate and DEI proposals. So it's like very cheap, but then the corporation pays millions of dollars to defend it. So it's a huge loss of focus and resources. They sued this climate activist. They withdrew the proposal and they're still suing them. And I think Exxon is one of, if not the best example of a company that says, I see all these constraints that have been forced upon us, and we see the risks that this creates to a great large oil and gas company, and we're going to fight back.
Wow. That is it's unbelievable. And I just keep going back to this idea of ESG funds when they first came about, that they were in this idea of divesting, and we're just not going to own Chevron and Exxon. And I think that they realized they weren't really making a big enough difference, maybe would be the way to say it, or they felt, hey, these companies aren't doing it. Guess what? Maybe if we actually, it's like the pirates boarding a cruise ship or something, right? Like they just figured, we're just going to board the cruise ship and we'll just take it over this way. And that's what's happening is that these folks they've infiltrated these companies, and that's how they're affecting change. And they're affecting change in ways that are negative for the shareholders because they look at it as shareholder primacy is not a thing to them. It's more of the stakeholder capitalism idea, which was also an interesting thing in that I had never even heard that term stakeholder before, right? And until actually a couple of years ago at our previous firm, they started to use that word there. And even when they were using that word there, I was like, what in the world? What is that concept of stakeholder and stakeholder capitalism? But this goes back to the 1980s, if I'm not mistaken. Is it Klaus Schwab? Is that his name?
Klaus Schwab. And this gets into in my opinion, the best long-term data that talks about the investment case for why this matters. Because American capitalism has been around for well over 100 years in most corporations in America that focus on maximizing value.
And we know what the returns are.
You know what the returns are great. And not only the returns are great, you build great companies. If you look at the largest companies in the world, how many of them come from America? Most of them. If you look at most technological innovation, where does it happen? It actually happens in America. Why? Because if you innovate in this country, you make a lot of money. Incentives matter, right? And so what do you contrast that with? You contrast that with Europe. Why? Because Europe actually implemented the exact same thing that these large asset managers are trying to do in America in Europe 40 years ago. In the early 1980s, Klaus Schwab, he was an economist, and he coined this term stakeholder capitalism. And what it really means is that every single stakeholder is of equal importance, whether it's the shareholder, whether it's the customer, whether it's the employee, whether it's the local community, whether it's the government, whether it's your fringe protester on the street, right? All these stakeholders.
The atmosphere is a stakeholder.
Yeah, the atmosphere is a stakeholder. And so really, in my view, what it is it's a lack of focus. And when you're focused on nothing, you're trying to appease everybody, you appease no one. And so that, in my view, is European capitalism, stakeholder capitalism in a nutshell. So you have 40 years of data. European capitalism on one hand, American capitalism on the other hand. And the return difference on an average year is about 3.5% per year. And as an advisor, and hopefully as clients listening to this, you know the power of compounding. Compounding returns is how you actually make massive returns, right? So we're not talking about 3.5% difference times 40. We're talking about 3.5% difference compounded over 40 years. That ends up being over 2,000% return difference. And that basically is the difference between being able to retire and not being able to retire. That's how important that what we're talking about is. And one more thing on 40 years. 40 years is about the average career of a person. So basically, you're talking about during your career, would you rather have 2,000% more returns or 2,000% less returns? That is what we're throwing away when we throw away American capitalism.
Yeah, I agree 100%. You can't, that's the proof is in the pudding. And so it goes back to the retirement crisis and how we need that 3.5%. That makes a big difference. And I think that ultimately what you guys are doing and the mission and all of that, I think that a lot of people out there, I'm just really probably speaking for myself, don't understand everything we're talking about. And I'm hoping that this podcast that we just got done doing will help shed light on this for the folks in East Texas to start to understand why these companies are doing what they're doing, the real crisis that we're facing and how it is truly like it matters, and why you need to make sure that your shares are being voted in a way that is shareholder first, primacy. And that's why like our model portfolios that we've put together, we call them shareholder first portfolios, because that's the way we see it, is that's what matters more than anything. And so I just think that what you guys are doing is very important work, and it matters, and people don't really understand it, but I think that's what we're trying to shed some light on, that to help people to understand it, that it really matters. And some of the things that we all think of, some of the things that keep us up at night, that we say, man, America is really in a bad way right now. And why is all this crazy stuff happening? And what's going on with America right now? And I truly believe that, 80 or 90% of that stuff that's happening is a result of what we just got done talking about, or these things that are happening, and that we've lost our way, and you guys are trying to help restore that. And so I think that's really cool.
Thank you. And you're obviously doing the same thing from a different seat. This is about the message, not the messenger, right?
Yeah.
And I do believe that when you start to build a movement, and hopefully this is a movement, and we're a part of that movement, you're a part of that movement, there's other people in this country that are part of that movement, we create a snowball of people that are pro-capitalism, pro-merit, and we can make a difference. And I think it's something that is critical to protect, defend, promote both capitalism, merit as a core principle. I think it's fair to say that a lot of the luxuries that we have in this country depend on us defending those core principles. And I'm very bullish on us being able to actually win this.
Yeah, I am too. Absolutely. Thank you so much again for everything we just got done talking about, and for sharing that. And I sure hope that this won't be your last trip to Nacogdoches, and hopefully next time we'll be able to have a big crowd and make a big deal out of it. So I'm really looking forward to that already.
Awesome. It's a lot of fun. Thank you.
You bet. Thank you.
For more information on Strive and their mission of shareholder capitalism, or to learn more about holistic planning and how we can add value to your life, please go to our website, holisticplanning.com. There you can schedule a call with somebody on our team. We'd be more than happy to talk to you. Thanks for watching.